The next market crash is coming. I don't know exactly when. Nobody does. It might be 6 months from now. It might be next week. But I can tell you this with absolute certainty: it will happen. And when it does, most people are going to do the exact wrong thing at the exact wrong time. They're going to panic. They're going to sell. And they're going to walk away with permanently less wealth than they had before the crash even started. But here's what nobody tells you. A small group of investors, people who understand one specific concept, are going to come out of that same crash wealthier than when it started, not because they're smarter, not because they have inside information, but because they prepared while everyone else was busy assuming the good times would last forever. Today, I'm going to show you exactly what that preparation looks like, step by step, with real numbers, real history. And a real plan you can start building today, not tomorrow, not after the next earnings report, today. Because by the time the crash arrives, it's already too late to prepare. Here's what we're going to cover. First, I'll show you why compounding, the most powerful wealth-building force that exists, is also surprisingly fragile, and why most investors accidentally destroy it without even realizing it. Second, I'll walk you through exactly how often crashes happen, because understanding the rhythm of the market completely changes how you emotionally respond to it. Third, I'll give you 4 specific, concrete actions you can take right now to position yourself so that a crash doesn't hurt you, it actually accelerates your wealth. Fourth, we'll talk about the psychology, because strategy without psychology is useless. You can know exactly what to do and still panic and do the wrong thing anyway. And finally, I'll show you the real data, the numbers that prove, beyond any reasonable doubt, why staying prepared and staying invested is the single most reliable path to long-term wealth. Everyone has heard of compounding. Your money earns returns. Those returns earn returns. Over time, that snowball grows into something extraordinary. Albert Einstein reportedly called it the 8th wonder of the world, and honestly, the math backs that up. If you invest $10,000 today and earn an average of 10% per year, which is roughly the historical average of the S&P 500, here's what happens. After 10 years, $25,937 after 20 years, $67,275 after 30 years, $174,494, you put in $10,000. You end up with $174,000. You didn't work for that extra $164,000. The math did it for you. That's the magic. But here's the part almost nobody talks about. Compounding has a fatal vulnerability, and it's called interruption. Let's look at the same $10,000. Year 1, you earn 10%. You're at $11,000. Year 2, another 10%. You're at $12,100. Great. Compounding is working. Then year 3 hits. The market crashes 40%. You're no longer at $13,310 where you should be. You're at $7,260. You've lost everything you gained in years 1 and 2, plus a significant chunk of your original investment. Now here's the mathematical reality that most people never fully grasp. To get back to $12,100 from $7,260, you don't need a 40% gain to recover. You need a 67% gain. That's the asymmetry of losses. Losses always hurt more than equivalent gains help. A 50% loss requires a 100% gain just to break even. This single mathematical fact is responsible for more destroyed wealth than almost anything else in personal finance. Most people don't just sit through the loss. They sell. They lock it in. They turn a temporary paper loss into a permanent real one, and then they wait on the sidelines, too scared to get back in and miss the recovery entirely. That's not bad luck. That's a predictable, avoidable mistake, and today you're going to learn how to avoid it. Before we talk about what to do, you need to genuinely understand how normal market downturns are. Because one of the biggest mental mistakes investors make is treating every crash like some kind of unprecedented catastrophe. It's not. Crashes are scheduled chaos. They happen on a rhythm, and once you know that rhythm, they stop feeling like emergencies. There are 3 levels of market decline you need to understand. Level 1, market corrections. This is any decline of 10% or more from a recent high. These are the most common. Since 1980, corrections have happened on average roughly every 1 to 2 years. If you've been investing for 5 years and haven't lived through a correction, you haven't been lucky. You've been building up to one. Corrections are healthy. They shake out speculative excess. They reset valuations. Think of them as the market taking a breath before the next climb. Level 2, bear markets. A bear market is a decline of 20% or more from a peak. Since 1932, bear markets have occurred on average every 4 to 5 years. They typically last around 289 days, just under 10 months. That sounds brutal, but here's the perspective that changes everything. Bull markets, the periods when the market is rising, have historically lasted an average of 965 days. That's more than 3 times longer than bear markets. The market spends far more time going up than going down. The recoveries are longer. The gains are larger. The trend over any long enough period of time is unmistakably upward. Level 3, full market collapses. These are the rare but severe drops of 30% or more. The 2008 financial crisis, the COVID crash of March 2020, the dot-com bust from 2000 to 2002, where the Nasdaq lost nearly 80% of its value. These are the events that feel civilizationally catastrophic when you're living through them, and they are painful. But every single one of them, every single one, was eventually followed by a full recovery and then new all-time highs. The question has never been whether the market recovers. It always has. The question is whether you will still be invested when it does. Here's where we get practical. These are 4 specific actions you can take today to make sure you're one of the people who comes out of the next crash ahead, not behind. Step 1. Build a real emergency fund. This is the foundation of everything, and I want to be very clear about what I mean because most people underestimate this. I'm not talking about a few $100s. I'm not talking about 1 month of expenses. I'm talking about 3 to 6 full months of your total living costs sitting in a high-yield savings account, completely untouched, earning 4 to 5% interest while it waits. Here's why this is the most important first step. During a market crash, life doesn't pause. Jobs get cut. Businesses slow down. Medical emergencies don't check the stock market before they happen. And when people don't have a cash cushion, they're forced to do the single worst thing an investor can do: sell their investments at the exact moment prices are lowest. They're not selling because they want to. They're selling because they have to, because they have no other option. An emergency fund eliminates that scenario entirely. It gives your investments the time they need to recover. It means a market crash can never force your hand. Think of it this way: your emergency fund is not an investment. It's insurance for your investments. Step 2. Automate dollar cost averaging. Dollar cost averaging is probably the most underrated strategy in long-term investing. Not because it's complicated, it's actually beautifully simple, but because the results it produces over time are genuinely extraordinary. Here's how it works. Instead of investing a large lump sum and trying to time the market perfectly, you invest a fixed amount at regular intervals, every week, every 2 weeks, every month, regardless of what the market is doing. When markets are up, you buy fewer shares because they cost more. When markets are down, you buy more shares because they're cheaper. Over time, this naturally lowers your average cost per share, but during a crash, it does something remarkable. Let's say you invest $300 every month into a broad index fund. In month 1, shares cost $30 each, so you buy 10 shares. Then the market drops, and in month 2, shares fall to $15. Your $300 now buys 20 shares. Month 3, partial recovery, shares at $20. You buy 15 shares. Over 3 months, you've invested $900 and acquired 45 shares at an average cost of exactly $20. If the market had never dropped, you'd have bought only 30 shares at $30 each. The crash didn't hurt you. It gave you 15 extra shares. This is why crashes are not disasters for the prepared investor. They are discount events. And the most important word in this entire strategy is automate. Set up automatic transfers. Make it so the money moves without you having to make a conscious decision each month. Because when the market is down 30% and the news is calling it the end of the financial world, your brain is going to tell you to stop. That impulse is exactly when you most need to keep going. Remove the emotion. Automate the system. Step 3. Diversify properly before the crash. Diversification is one of those concepts everyone thinks they understand, but most people get wrong. It does not mean owning 15 different tech stocks. It does not mean splitting your money between Apple and Tesla. True diversification means spreading your investments across different asset classes, different sectors, and different geographies so that when one area collapses, the others provide stability. A well-diversified long-term portfolio might include a core position in a broad U.S. total market index fund, some exposure to international developed markets, a smaller allocation to emerging markets for growth potential, some bonds for stability and crash resistance, and perhaps a small allocation to real estate through REITs. The exact percentages depend on your age, timeline, and risk tolerance, but the core principle is the same. No single bet should be able to destroy you. Here's why this matters specifically for compounding. When one part of your portfolio drops, you can rebalance, selling a bit of what held up and buying more of what dropped. That's mechanically forcing yourself to buy low and sell high, which is exactly what most emotional investors fail to do. And done consistently, rebalancing significantly improves long-term returns. Step 4. Write a written investment plan. This one sounds almost too simple, but it might be the most powerful thing on this entire list. Before the crash happens, while you're calm, while you're rational, while you can think clearly, write down your investment plan. Physically write it or type it somewhere you can access it later. It should answer these questions. What am I invested in and why? How much short-term loss can I genuinely handle? What will I do if the market drops 20%? What will I do if it drops 40%? What is my investment timeline? When the crash comes, and it will, and your portfolio is deep red, and every financial headline is screaming catastrophe, you pull out that document, and you remind yourself that you already made this decision. You already knew this might happen. You already decided what to do. That document becomes your anchor when your emotions are trying to sink you. I want to spend real time here because honestly, this is the part that actually determines whether most investors succeed or fail. It's not strategy. It's not stock selection. It's psychology. Here's what happens inside your brain during a market crash. Your portfolio drops, you open the app, you see the red numbers, and your brain, which evolved over hundreds of thousands of years to respond to immediate physical threats, interprets those numbers as danger, as something to escape from, right now. Psychologists Daniel Kahneman and Amos Tversky, who literally won a Nobel Prize for this research, found that the pain of losing money is approximately twice as powerful as the pleasure of gaining the same amount. Losing $1,000 feels about twice as bad as gaining $1,000 feels good. This is called loss aversion, and it is hardwired into human biology. It's not a character flaw. It's not a sign of weakness. It's the same instinct that kept your ancestors alive when they needed to avoid predators. But in a stock market context, that same instinct will absolutely destroy your long-term wealth if you let it drive your decisions. Here's the brutal truth about panic selling. When you sell during a crash, you don't just lock in your losses. You also remove yourself from the recovery. And the recovery almost always happens faster and more aggressively than anyone expects. During the COVID crash of March 2020, the S&P 500 fell 34% in just 5 weeks. Investors who sold at the bottom, thinking they were protecting themselves, watched the market fully recover by August 2020. 5 months later, the people who stayed invested didn't just avoid the loss. They captured some of the best returns in recent market history. There's also a famous story about legendary fund manager Peter Lynch. He managed the Fidelity Magellan Fund from 1977 to 1990, delivering an average annual return of 29.2%, one of the greatest long-term track records in investing history. But here's the stunning part. Despite those incredible returns, many of the fund's actual investors lost money. Why? Because they bought in during hot markets when performance was exciting, and they sold when things dropped. They let their emotions override their plan. They did the exact opposite of what the strategy required. The solution is not to somehow stop feeling fear during a crash. You will feel it. Everyone does. The solution is to make your decisions before the fear arrives, when you're calm and clear-headed, and then commit to those decisions in advance. That's what the written plan is for. That's what the emergency fund is for. That's what automation is for. Every single element of this strategy exists to protect you from yourself at your worst moment. Let's close with the numbers, because I want you to walk away from this not just with a strategy, but with genuine conviction in that strategy. A study by Fidelity looked at what happened to a $10,000 investment in an S&P 500 index fund from January 1980 to the end of 2022. If you stayed fully invested the entire time, that $10,000 grew to approximately $1,082,000. But if you missed just the 5 best trading days over those 42 years, 5 days out of more than 10,000, you walked away with only $671,000, a difference of over $400,000 for missing 5 days. And if you missed the best 50 days, you ended up with just $76,000. You took on the same risk. You sat through the same crashes. You just weren't invested on the days that mattered most. Now here's the part that makes this even more striking. According to JP Morgan research, 7 of the 10 best single-day returns in S&P 500 history occurred during or immediately after the 2008 financial crisis. The best days tend to cluster right alongside the worst days. When you sell during a crash to protect yourself, you're almost certainly going to miss the explosive recovery days that follow. Because those days come suddenly, without warning, and you have to already be invested to benefit from them. Let's look at a real example. Between October 2007 and March 2009, the S&P 500 fell approximately 57%, A $100,000 investment fell to around $43,000. That is genuinely terrifying to live through. But an investor who kept putting in $500 every month throughout that entire decline was buying shares at dramatically reduced prices, shares that would eventually recover and grow to multiples of what was paid for them. The crash didn't just stop hurting them, it became one of the best wealth-building periods of their investing life. The same story repeated in March 2020 and in 2002, and after every major crash in modern market history. The crash is not the enemy. The reaction to the crash is the enemy. Let me bring everything together. Market crashes are not rare events. They are a completely normal and recurring feature of investing. Corrections happen every 1 to 2 years, bear markets every 4 to 5, major collapses roughly once a decade. If you invest long enough, you will experience all of them. That is not a threat, it's a fact you can prepare for. Compounding is the most powerful wealth-building tool available to regular investors, but it only works if you don't interrupt it. And interrupting it at the wrong moment, by panic selling during a crash, can cost you not just money, but years of growth that can never be recovered. The 4 things you need to do right now are: 1. Build a real emergency fund. 3 to 6 months of living expenses in a high-yield savings account. This is your crash insurance. 2. Set up and automate dollar cost averaging. Let the system invest for you even when your emotions are telling you to stop. 3. Diversify properly across asset classes, sectors, and geographies. No single area should have the power to devastate your entire portfolio. 4. Write a written investment plan. Decide now what you'll do when the market drops 20%, 40%, even more. Commit to it before the fear arrives. The investors who get rich through market crashes are not geniuses. They are not lucky. They simply prepared while everyone else assumed the market would go up forever. You now know exactly what they know. The only question left is what you're going to do with it.